For years, new-build apartments in the UK were seen as the easy option: modern, low maintenance, lift access, energy efficient, perfect for downsizers, attractive for buy-to-let UK investors, safe, you might have thought, if you were planning retirement. But something has shifted. Across parts of the UK property market, shiny new flats are completing and they are not selling as expected. So here's the question that matters if you're 54 or older and own property. Is this a short-term slowdown or a structural change that could affect the value of your home over the next 5 years? Let's take a calm look at what's really happening. Over the past 2 years, mortgage rates UK rose sharply following consecutive base rate increases from the Bank of England. Even though rates have eased slightly from their peak, they remain far higher than the ultra-low levels we had for over a decade. At the same time, build costs surged, materials, labour, compliance, energy standards. Developers priced new apartments accordingly, but buyers didn't adjust in the same way. House prices UK have been broadly stable in many regions, according to recent market data and major portals like Rightmove. Yet, new-build flats, especially city centre stock, have seen weaker demand compared to houses, and that matters more than most people realise. Imagine you own a £375,000 home in Leeds. You're mortgage-free. You're thinking about downsizing within the next 3 years to release equity for retirement. You look at a brand new apartment nearby, priced at £310,000. It looks appealing: secure entry, underground parking, low heating bills. But when you ask the estate agent about resale demand, the answer feels uncertain. This is where caution starts creeping in for many homeowners aged 54 and over. Because at this stage of life, you're not chasing growth, you're protecting capital. You're thinking about inheritance, stability, liquidity. And here's the first layer people overlook. New build pricing has been sitting above local resale values in many areas. Developers built based on 2021 optimism. Buyers are now operating in 2026 caution. That gap is creating friction. Now let's widen the lens. In Newcastle-under-Lyme, a 655-space multi-storey car park is being converted into 111 flats. The logic? Repurposing existing structures cuts cost and carbon. It's clever, efficient, marketed as forward-thinking. In Bradford, a 1970s office tower, once vacant for 25 years, has been converted into 87 flats after a £12 million regeneration. Fully occupied now, a second life. Across the country, older commercial buildings are being turned into apartments. Councils are backing regeneration. Developers are racing to deliver urban living. But here's the tension. If supply is increasing, especially flats, who exactly is the buyer? Young first-time buyers are stretched by mortgage rates UK. Buy-to-let UK investors face higher borrowing costs and tighter tax rules. And older homeowners? Many are staying put.
If you own your home outright at 60, moving into a flat with service charges, ground rent and management fees feels less attractive than it did 10 years ago. And this is where many homeowners make a costly mistake. They assume all property segments move together. They don't. Detached houses in family suburbs behave differently to city centre flats. Period homes behave differently to high-density developments. The UK property market is not one market. It's multiple micro-markets moving at different speeds. Let's look at a second scenario. You're 58. You own a 4-bed home in Nottingham worth £480,000. Your children have moved out. You're considering downsizing to a new 2-bed apartment at £340,000, releasing £140,000 for pension top-up. Sounds sensible. But the apartment has a £2,400 annual service charge. There's a sinking fund. The lease terms run 125 years from 2022, and similar units in the same block are offering incentives because sales are slower than forecast. If prices soften by 5 to 8% in that development due to oversupply, that £340,000 purchase could look different in 2 years. This isn't about fear, it's about timing. Developers often release units in phases. Early buyers pay premium prices. Later buyers sometimes receive incentives quietly. Furniture packs, stamp duty contributions, deposit boosts. That affects comparables.
Now let's anchor this in broader data. Recent UK housing forecast discussions suggest modest, regionally uneven growth over the next 12 to 24 months rather than sharp increases. Transaction volumes remain below pre-2022 levels. Mortgage approvals are improving but not booming. In the buy-to-let UK segment, yields on flats are under pressure in certain city centres due to supply increases. At the same time, family homes in commuter belts are seeing steadier demand because rental families are staying longer. Stamp duty thresholds, energy efficiency requirements, and lending criteria have all tightened compared to a decade ago. None of this spells collapse, but it does suggest selectivity matters more than ever. Let me pause and ask you something. If you were forced to sell in 5 years, not 10, would you rather own a standard family house in a stable suburb or one of 200 near-identical flats in a high-density block? It's worth sitting with that. So far we know this. Borrowing costs are higher than the 2010s, developers increased flat supply in regeneration zones, investor appetite is more cautious, and older homeowners are more selective. Now, here's the angle most commentary misses. The real issue isn't that nobody is buying new shiny apartments, it's that the buyer profile has changed. During the low-rate era, cheap debt fueled investor demand. Small landlords could borrow at 2%, yields worked, capital growth covered mistakes. In 2026, that arithmetic is tighter, which means developments reliant on investor-heavy sales are slowing first, and that links directly to retirement planning. If you are 54 plus, your property is likely your largest asset. When you downsize, you are converting housing equity into lifestyle security. If you move into a segment where demand is thinner, resale risk increases. That's the hidden shift. The market is quietly favoring scarcity again. Unique homes, good schools, transport links, low-density areas. Mass-produced city centre flats face more competition, not necessarily today, but when the next phase completes down the road. And this matters for inheritance too. If your goal is to pass on a stable, easily saleable asset, liquidity matters as much as headline value. Now, let's talk about the next 12 to 24 months. Mortgage rates UK are expected to move gradually rather than dramatically. The Bank of England is cautious about inflation returning. That suggests we're unlikely to see a rapid return to ultra-cheap borrowing. Developers, meanwhile, are adjusting. Some are slowing new starts. Others are pivoting toward build-to-rent models rather than individual sales. That could support prices in certain schemes by limiting immediate oversupply. But I would expect the UK property market through 2026 to remain segmented. Houses with gardens in solid areas may see steady demand. Generic new-build flats in oversupplied zones may require incentives to transact. That's not a crash narrative, it's a selection narrative. If you're a landlord, this means running numbers carefully. Net yield after service charges, realistic void periods, exit liquidity. If you're a downsizer, it means comparing not just purchase price, but long-term desirability. If you're staying put, it may mean you're in a stronger position than you think. Let's close the loop. At the start, I asked whether this slowdown in new shiny apartments is temporary or structural. The answer is this. It's not about aesthetics, it's about financing conditions and buyer psychology. When money was cheap, density worked. When money is cautious, scarcity works better.
For homeowners aged 54 and over, the key isn't to panic or rush. It's to recognize that not all property types will perform the same over the next cycle. One clear takeaway: before downsizing into a new build flat, look beyond the brochure. Ask about resale history in that block, future phases, service charge projections, who the typical buyer will be in 5 years. Because at this stage of life, protecting flexibility is just as important as releasing equity. If you want steady, clear updates on where the UK property market is heading, including what the latest UK housing forecast trends mean for retirement decisions, consider subscribing. I'll continue tracking the data so you don't have to.